The Shariah compliance process in Islamic finance, how it works. Introduction. Islamic finance operates under Shariah, Islamic law, ensuring that all financial activities comply with ethical and religious principles. Unlike conventional finance, Islamic financial institutions must adhere to strict guidelines that prohibit interest, riba, excessive uncertainty, gharar, and investments in haram industries. Understanding Shariah compliance in Islamic finance. Shariah compliance ensures that financial transactions, investments, and banking operations align with Islamic ethical and legal standards. It covers prohibition of riba, interest. Islamic finance replaces interest-based transactions with profit-sharing models such as mudaraba and musharaka. Avoidance of gharar, uncertainty and speculation. Contracts must be clear, transparent, and free from excessive risk. Halal investment screening. Funds cannot be invested in industries like alcohol, gambling, tobacco, or weapons. Ethical financial practices. Business dealings must be just, fair, and socially responsible. Key components of the Shariah compliance process. First, establishing a Shariah Supervisory Board, SSB. Islamic financial institutions, banks, investment firms, and fintech platforms appoint Shariah scholars to form an independent advisory board. Their role includes reviewing and approving financial products before they enter the market, ensuring contracts and transactions follow Islamic principles, conducting audits and issuing fatwas, legal rulings, on complex financial matters, monitoring financial institutions for continued compliance. Second, Shariah screening for investments. Islamic finance follows a two-step screening process to evaluate potential investments. Qualitative screening, ensuring businesses do not engage in haram activities such as alcohol, gambling, and interest-based lending. Quantitative screening, examining financial ratios, such as debt-to-asset ratio, ensuring companies do not rely heavily on interest-based debt. Revenue from non-compliant sources, limiting non-halal income to a minimal percentage, usually less than 5%. Third, structuring Shariah-compliant financial products. To replace conventional financial instruments, Islamic finance uses alternative contract structures, including mudaraba, profit-sharing partnership. Investors provide capital, and entrepreneurs manage the business, sharing profits based on an agreed ratio. Musharaka, joint venture investment. Partners contribute capital and share profits/losses based on their investment percentage. Ijara, Islamic leasing, a rent-to-own model, where assets are leased with an option to purchase. Murabaha, cost-plus financing, a transparent buy and sell contract where banks purchase goods and sell them at a markup, instead of charging interest. Sukuk, Islamic bonds, asset-backed securities that generate returns based on ownership, rather than interest. The role of Shariah advisory institutions. To maintain standardization and credibility, international bodies oversee Islamic financial regulations, including Accounting and Auditing Organization for Islamic Financial Institutions, AOIFI, establishes Shariah accounting and governance standards. Islamic Financial Services Board, IFSB, develops risk management and regulatory frameworks for global Islamic finance. Shariah Advisory Councils, SACs, national-level bodies ensuring financial institutions follow local Islamic finance regulations. Challenges in Shariah compliance. Despite its structured framework, Islamic finance faces several challenges, including diverse Shariah interpretations. Different scholars and regions may have varying opinions on compliance. Complex product structuring. Creating Shariah-compliant alternatives to conventional financial instruments can be challenging and time-consuming. Lack of awareness and expertise. Many businesses and investors are unfamiliar with Islamic finance principles, limiting market adoption. Conclusion. Shariah compliance guarantees that financial activities align with ethical and religious principles. Adherence to Shariah rules ensures clear and fair financial practices. Investments must contribute positively to society and avoid harm. Prohibiting interest and speculative practices fosters economic justice. Risk-sharing mechanisms reduce financial crises and instability. If you want to learn more Islamic finance, follow us for more insight.